What happens to some of these mining stocks when the Fed just says we are going to force the price higher?
Well, it was unprecedented when they said we're going to act aggressively and forcefully to make sure the economy doesn't falter. I mean, that's a pretty forcefully and aggressively.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And I am quite excited because we have a first-time guest to the show today, although someone that I'm guessing you're already well familiar with, because I am joined by Frank Holmes, the CEO and Chief Investment Officer of U.S. Global Investors, which the symbol is GROW on the NASDAQ. Frank has also won a series of awards, not just for in the mining sector, but also in terms of education, which for everybody watching who follows the show knows I'm quite big on. And Frank, I appreciate you being here because maybe as we can talk about today, yeah, it's great if you have a good financial advisor, but when you have actually some understanding yourself and can really take ownership of the process, it's hard to top that.
No, it's a passion. Some have passion for gardening, and others have passion for being early to see a great company like Apple become what it is, or the gold mining industry, the formation of capital and developing something that hires people and creates wealth. It's a beautiful feeling.
Yeah, and speaking of passions, one thing that we were reminded of this week is that the Federal Reserve seems to have a passion for printing money. I mean, quite a half year. We're in September now, and you look back to March, we had quantitative easing, unlimited quantitative easing, interest rates to zero through 2022. This week, it got extended. They're even talking about something called inflation targeting. And I'll bet a lot of the things that drew you initially into gold many years back.
Well, Chris, there's interesting, my experience when I first moved from Canada to Texas 30 years ago. So I'm known as a Tex-Can. Y'all come back, eh? Is growing up there. Toronto still is the mining finance capital of the world. 60% of all capital formed and analysts. And so I'm steeped in that business there. But what I try to share with people is that the world, you have to go back and look at history, and you have to put it in the context. And I found that there's lots of these gold bugs, and it's like the joke that the person's always saying, "Oh God, it's not fair. I just can't win the Texas lottery. It's just not fair. It's now $100 million. Why me? Why can't I win?" And voice from heaven comes down, and God says, "Buy a ticket."
Yep.
And so you meet all these gold bugs, and really they're so emotional, but they actually don't invest in it. It's really their anti-political party. And you then meet the very brilliant people like the Seymour Schulichs and the Pierre Lassonde, who created Franco-Nevada, the first company I actually took public in 1983. They believe that government balances between their monetary and fiscal policies will always get out of whack. And when it gets out of whack, gold becomes a great insurance, and gold becomes a great way to protect your wealth on the downside, but also enhance it on the upside.
Yeah, and it's interesting. You mentioned all the way back to 1983 and before. A lot of the same things that people were seeing back then, we're seeing now, just farther along, farther advanced. I mean, it wasn't like you just picked up a couple of weeks ago because the gold price hit 2000. What's it been like seeing this unfold? I mean, I started in 2009. I can't imagine what it was like going that far back.
Well, just to give you sort of important history for gold in this cycle we're in, we saw this like in 2000. So there's lots of history when you have a credit crisis. It takes 4 years for that balance sheet of a country to repair itself. So in 97, there was the Asian crisis, and 98, Russia defaulted on their sovereign bond. So it basically was not until 2001, 2002 that Asia and Russia had repaired themselves, and all of a sudden 9/11 takes place all at that same time. So we have a bottoming happening 9/11 takes place, tech bubble was, and you started to see a cartel being formed by finance ministers and central bankers. So the G20, G7 grew to the G20, and they meet all the time. They meet together and they have policies. So in the early 2000s, we saw this drive globally for trade, drop regulations, facilitate global trade. And with that, we had a huge move in growth in GDP per capita. We saw the GDP per capita, the purchasing power of China and India basically come from nowhere to all of a sudden they're 1 in 3 in the world. And it's these sort of policies. But interesting enough, this is when it started. Gold has been up 80% of the time for the past 20 years. It's really hard for people to grasp that, but in this push for global trade did help lifting the poverty for so many people around the world. 2 billion people basically went above the poverty line, which is significant. Lots of benefits to it. And along comes 2008-9, and these sort of cartel of finance ministers, central bankers, all of a sudden it's synchronized global taxation and regulation. Big change. And we saw gold levitate from 700-800, soared in 1900. They had to take real interest rates up to basically get gold down to 1,000. And then it's been a slow march since then of gold sort of slowly creeping up. And now we're back to this big negative real interest rate scenario. But in the past 20 years, Ray Dalio's fund became the biggest hedge fund in the world. And he's an advocate of gold. He has a 7 to 15% weight. And it still doesn't resonate with pension funds, except for in Texas. It doesn't resonate in New York. And I think this is the most fascinating part, that we've still got a long way to go, because we now have these imbalances and we're seeing unprecedented change in the formation of capital. Like you just showed, negative interest rates for the next 3 years. We have Japan, we have Switzerland. You know, these 2 countries have owned 15% of their stock market. Yeah. Japan's through ETFs. Switzerland has massive, real negative interest rates, and they float these bonds. No one buys them but the government, and they go buy Apple stock. So that's smart, because they're buying dividend growth. Buffett finally wakes up and says, holy heck, you know, I'm missing something. I've got FOMO now, but he's not going to buy bullion. He's buying a Barrick, because Barrick has a high free cash flow yield and is much higher than the S&P 500. So there is a sea change with negative or real interest rates. Those are going to get wealthy. It's not so much being anti-government and all this stuff. No, buy real assets. You have your real estate, you buy your gold, you buy your silver, and you buy good quality gold stocks, which are throwing off free cash flow. And that's what the smart guys like Buffett. And Buffett coming in now and buying Barrick is a major sort of swarming that takes place in the capital markets.
Yeah, I think that's the kind of thing that catches people's attention. It's funny, I was talking with an investor earlier today, and they were mentioning how people are jumping in now that it's hit an all-time high, which seems a little antithetical to the buy low, sell high. But hey, Americans, they chase momentum. And when you look at, we have a 0.6% 10-year treasury yield, while the Fed is now saying 2% inflation isn't enough. We have stocks like Tesla up 10x since we started swap lines last year. I mean, where else are investors supposed to go outside of the metals right now?
Real assets or great technology, which is going to disrupt an industry. So we have disruption by monetary policy of capital and the formation of capital. The first mover advantage is to recognize that and own some gold and own something. Like I always say, that 10% golden rule is always have 10% and rebalance. So it's a quarter once a year, but it's done Ray Dalio exceptionally well to become the largest hedge fund in the world.
Yeah, that makes a lot of sense. Frank, we had a conference over the weekend, and one of the questions that came up a lot was, how is what we're seeing in 2020 different from 2011? Similar, maybe more mild example in 2016, but it seems, especially in some of the mining stocks, I get the sense from the folks I talk with, it's like, well, I don't want to jump in yet and get burned again. Curious what you're seeing there. And again, differences between what we're seeing now and 2011.
Well, the big fundamental difference, if you look at gold stocks, is that the industry was always plagued with bad decisions, raising money, not increasing the income statement, not having positive free cash flow. And we saw lots of CEOs lose their jobs. And you now have a group of leaders that believe in free cash flow. And to me, this is most fascinating because last September, I look at these 75 North American listed gold companies, producers that are, there's 400 overall listed companies, but there's 100 global producers, but really there's 75 that you can buy and trade on a liquid basis. Those companies, this time last year, had negative as a group free cash flow, but the S&P had positive free cash flow of 2.5%. So naturally, money is going to go to where there's free cash flow because there's a capacity to pay higher dividends. And with zero interest rates, dividends become extremely attractive.
Yep.
That's why Switzerland floats negative rates and buys Apple, and they get a positive rate of return on the dividends alone, and they have capital appreciation. So what we saw in March with the COVID crisis, you saw the S&P 500 stocks, the majority of them have their free cash flow yield wiped out, but not gold stocks. All of a sudden, their average started with 1%. Big change in the past 15 years, positive free cash flow. End of June, the industry is now 2.5%. Barrick is 4.5%. Buffett buys Barrick. The royalty companies like Frank and U.S, I always would prefer that because it has revenue of $24 million per employee versus $600,000 for Barrick, and they have the royalties on Barrick. So I've always had a sort of an affection for the royalty companies. But coming back, what we're seeing though as a universe, this quarter is going to have record free cash flow. June comes along earlier this year. I said, do you higher free cash flow? Guess what? Kirkland Lake is showing up in the IBD top 50 stocks to buy. Franco-Nevada, top 50 stocks to buy. They're up there with NVIDIA. They're up there with AMD. They're up there with Lowe's Construction is having on a tear also. They're a beneficiary of the COVID crisis. So now you want to be looking at the stocks that have the capacity to have growth and revenue. And the first thing to do outside of gold is look for who's hiring. So you saw at the beginning of the cycle, Amazon announced 100,000 people they hired. They just announced it again, another 100,000. If you looked at California Pizzas, they went bankrupt, but Chipotle hired 10,000 people because they had a better delivery mechanism. So the idea of investing is, what's your first mover advantage? And there's the great billionaire investors, Warren Buffett's sidekick, Charlie Munger, is having lunch with another great global investor, Howard Marks. And Howard Marks talks about level 2 thinkers. There's lots of level 1 thinkers that are lawyers and doctors, accountants, but they don't think about this level 2 of how to process this information to make money and have the first mover advantage. Don't become anti the government for the sake of not buying the gold. Say, okay, governments will make mistakes. When is the best time to do that, to buy gold? Or now we have a World War III. It's invisible. It's the COVID crisis. So now the G20 countries collectively pull together. They say, let's work together. We're all going to print money. We're all going to be collectively in this sort of race to zero. And you and I and people that listen to it, their first move advantage for listening to Ray Dalios of the world, they go and buy some gold and gold stocks or any public company which has the capacity to maintain free cash flow.
Yeah, I appreciate you mentioning that, Frank, because, you know, on one hand, I think there's challenging times for a lot of people out there, yet no matter what position we're in life, whether our savings are X, Y, or Z, when we look at, all right, I'm here right now, what are the resources I have? Maybe if it's not a lot of capital you have, people that respect you, or that you can talk with, or a skill. Everyone has some skill, some ability that they've developed. And it was nice. I was listening to one of your interviews before we started the call today. You have quite an entrepreneurial background, especially in the education. And I think, and you talked about a little before we started recording, maybe you can mention again just how, it's that type of thinking that in whatever situation you're in, if you look at some way to you see there's plenty of problems out there for solving, and maybe you could pass along a lesson or two you've learned from your entrepreneurial journey.
The greatest country in the world is America. As a Canadian living here 30 years, almost half my life, it is still, you can find all the faults you want. It is the greatest country in the world because the respect for private property, rule of law, common law. It's really quite remarkable because it attracts innovation and entrepreneurs. It's so easy to find all the fault, and freedom of speech allows you to do that here. In other countries, you can't do that in China. You can't do that in Russia. We're going to go back to Middle Ages when they're poisoning everybody. Now that's what takes place in the Russias of the world. Just that spirit of innovation is breathtaking in this country. And so I think that investors really have to look at it. Sure, you can be critiqued, but don't be negative. Think of level 2. How do I stay ahead? Is stay ahead by understanding, and Peter Lynch wrote a wonderful book back in the 80s called One Up on Wall Street. And it was a simple book. Yes. And he said, if you like the product, then buy the stock. And I remember in March, and the lockdown took place, all of a sudden, I went out to the Home Depot. The parking lot was filled. Everything else was empty. So what's going on here? And then start looking and doing a quick quant analysis on it, and Lowe's, and you see that they're growing. Buy the stock. Gold, you see big imbalances with government policies. Buy the gold. Make sure you own it. As an asset class, don't put all your life savings into it, but the golden rule, having 10%, it's just wise and prudent.
Yeah, that makes a lot of sense. And Frank, with a lot of people, even from the mainstream now, jumping into gold and silver, what could you tell them, especially folks who are new to the mining stocks, might be interested in getting involved, but certainly you have quite a wealth of experience there. And what would you say to people who are just digging in?
Well, we all have a DNA that gives us a different look, height, weight, etc. We all know this so well. We all have different fingerprints. Each asset class has its own DNA of volatility. And you as a professional options trader know that so well. And you basically are selling gamma and time against a volatility. Well, gold has the same volatility as the S&P 500. But most of those talking heads on CNBC, oh no, gold's very volatile. It's not. Its daily volatility is plus or minus 1%, 70% of the time. If we go over 10 days, it's plus or minus 3%. Both the same. Go 12 months, both the same. But gold stocks, they're 3% daily. They all of a sudden push 6% over 10 trading days. So it's recognizing and understanding what the DNA of volatility is of a different asset class allows you to manage your expectations and be able to trade around those positions, or if you're taking a core position, buy on the down days. You have a thesis, they're going to have this DNA volatility, buy in the down days. I think that's really important to share with investors.
Yeah, that's great advice, because again, anything towards recognizing the market's going to do what it's going to do, whether we like it or think it's fair, which may have their relevant place, but I find the more we accept things as they are is helpful. I have a couple of companies that I was hoping you could give us a comment on in my notes here. The first one is Wheaton Precious Metals. I know you mentioned that you are a fan of the royalty streamers, and perhaps any comment on that one?
Well, I'm so fortunate, as I mentioned earlier, I'm just blessed. God has blessed me to be able to look back and not realize taking Franco-Nevada public and what it would become. And I remember it had merged in the year 2000 basically into Newmont, and then it was spun out in 2008, the Franco-Nevada. But during that period, there was only one big royalty company, in Denver called Royal Gold. And there was a need for something in silver. So we were involved in the creation of Silver Wheaton, and it was basically buying silver royalties. And it became just a superstar. And it's one of those companies where Randy Smallwood is from day one. He's technically competent. I mentioned earlier what they call the efficiency ratio. They have about $22 million of revenue per employee. Goldman Sachs is $1 million. Mining companies are $500,000 to $600,000. I'd rather any day own a royalty company because they have a moat around their business. They have very high gross margins. It's a remarkable to take a look at. I remember talking to Pierre Lassana in Franco, Nevada, and he said, yeah, we do 500 million in revenue, and our total cost of running the whole business and everything is 50 million a year. That's $450 million of free cash flow. What's that worth? And everyone can go away to Hawaii and they can clip those coupons for the next 30 years. Yeah. It's a superior business model. So that's why I love the royalty companies. And it doesn't mean I don't love gold stocks, but when they go and put the good housekeeping seal on a company, then automatically I'm more interested in putting my capital along with that. So recently, Randy Smallwood put money into a company called in Colombia. I know Colombia well. I know it was a spin-out of Gran Colombia. Gran Colombia is the largest gold producer there. It's a high-grade operation. There's a company that trades at 3 times cash flow, and the average gold mining stock trades at 13. So that's a cheap stock. So rather than dilute the company out, what they did is a model coming out of South Africa from back in the 60s. They spun it out. And they spun Caldas out rather than dilute their own holdings, but they own more than 50% of the company, and it was financed separately, and Wheaton put their team on it, and they put money into it. So to me, that was a good housekeeping seal. Is the Marmato project, produces about 2,000 ounces a year, but here's a company that is fully funded with equity and royalties and a gold note. When you take a look at it over the next 5 years, they can take the production from, I think, 24,000 to about 160,000 ounces. Well, there's very few companies can give you a magnitude of almost 5 times your growth over 5 years. So I think that stocks like that I like because it's going to go through a re-rating and I can make a big score. So I put a small portion in it. I'm a big investor in it, but it's a small portion of my overall funds because this is the type of things where I think I can get much bigger bang for my dollar. But the Gran Colombia, it pays a dividend now. It has free cash flow. It has the highest free cash flow yield in its universe. So I love that. They're not going to dilute that. So they create the Caldas. I think is smart.
Yeah, and Frank, one final question I have for you here today. We've seen how some of these stocks react with gold at $2,000, silver still a little catching up to do, although, again, it seems like the Fed's going to make sure silver gets to levels that we have not yet seen. What happens with some of these gold projects when you get $2,500 gold or $3,000 gold? I mean, we even have Bank of America talking about it now. So it's not just, the gold bugs we're always talking about. But even those gold bugs, I mean, gold was $35 about 50 years ago. So a little bit of a return as it's around 2,000 bucks. But what happens to some of these mining stocks when the Fed just says we are going to force the price higher?
Well, it was unprecedented when they said we're going to act aggressively and forcefully to make sure the economy doesn't falter. I mean, that's a pretty forcefully and aggressively. So get ahead of the curve. With money, they're going to print all this money. It's got to find a home. And money always looks for the highest, safest income. Yep. So I think gold stocks, and as long as they show this discipline, we're going to see the smarter, to me, early money movie in this theme go into gold producers, which are going to increase their production and have a low cost production file. And then they're going to go exploration. That will always take place. But what's happening, Chris, is unprecedented. I have a JETS ETF. And in the beginning of March, it halved in value. And then $1 billion came in over 70 days. It's all like biblical proportions. And the start of that was all these millennials stuck at home that are more sophisticated. It reminded me of the 90s when everyone discovered mutual funds. Now they started buying ETFs. Something like 40,000 of them rolled into Jets ETF. 25,000 bought the ETF before Buffett said he got out of the airlines, and then the Jets jumped by 50%. To me, there's something happening here. I see all this negative news about them, but they buy gold. And if you go to the Robinhood website, they even have a column for gold. Merrill Lynch doesn't have that. Schwab doesn't have that. So young millennials are speculators, which is smart because not my age shouldn't be taking such big risks, but when you're younger, you should be. I think it's going to be very important for price discovery, that we're seeing more money going from millennials going into investing than stock buybacks. The regulatory world is squeezed out all market making. So what's happening now, it's all gone to quant shops like Citadel, but they still need market making. And for me, I just see better price discovery, better liquidity in the small cap and mid cap space now. So we are in a very interesting super cycle in gold. And I think that we're going to see more and more investing in the space. What they have to realize is that junior mining is very, very speculative. But when you go look at a stock like, say, the Caldas, and you have institutions like Wheaton putting money up and they bought a piece of the equity deal, that gives it a much greater level of de-risking it for me. They've de-risked that project. Doesn't mean it's not fraught with risk, country risk, whatever, but they've de-risked it substantially. I think that they're the stocks I like to have.
Yeah, that makes a lot of sense. And Frank, I think what's really exciting is that people of all ages can learn. I mean, it's quite a career that you've put together. Again, as I mentioned before we started, reminds me a little bit of the Hunt brothers, where, I mean, in addition to the silver thing, and they developed Major League Soccer, I think one of them named the Super Bowl. And it's really nice to catch up with you. I've been hearing about you and watching your interviews for quite a while, and I think people will really appreciate being able to draw on your experience from everything you've done these past few decades. And perhaps just in wrapping up, you can let folks know the best way to keep track and to find you, or if they are looking for help in their investments.
Well, we're not investment advisors directly with the public, but we create products, and we have the Jets ETF, and we created also a quant gold very tightly with royalty companies and mining companies called GoAU, listed on the New York Stock Exchange. It's through $100 million in assets, very liquid. It's a quant approach rather than just buying an index. Every quarter we recalibrate it. And the best place to is go to usfunds.com and get the investor alert. Highly subscribe to Frank Talk. As there's my happy face looking over a mining company, but sign up for it. Please, we do a lot of education. We just did 2 great videos, I think, on explaining the Golden Cross. What does it mean? It's only a couple minutes. And then we talked about earlier, CPI. It's a joke when they say inflation is 1.3%. Real estate's up 10% over the past year. And if you use the CPI formula that was being used in 1980 when silver hit $50 and gold hit $8.50, if you use that model today, we're talking about 8% inflation. Now that's what I'm relating to. So I think that you can borrow cheap money, fix up your house. That's why the Home Depots are doing well, because smart people are doing that. And smart people are buying gold, and they're buying gold stocks that have a growth profile like Grand Columbia's and the Caldas spin-out that they have. And Caldas will get their gold note listed in Toronto in next month, I believe. And you're going to get 7.25% coupon that pays every month, and as gold trades higher, gives you a higher piece. Beautiful. I think that that's where the smart money is going to go.
Yeah, well, I appreciate that, Frank. And yeah, it's incredible that the CPI leaves out mortgages. I mean, not like that's relevant in any way, but fortunately, rather than listening to Jerome Powell's next press conference, they will be able to hear this interview with you. So again, thanks so much for joining me. It was a pleasure catching up with you, and we'll have to do this again soon.
Thank you, my friend, and happy and safe investing.